Individually tailored investment portfolios, ITIP. It is possible to achieve better gains with the same or less risk than most investors are realizing today. This short video will explain why. Why it's possible to achieve better gains with the same or less risk. As explained in Getting Back to Business by Daniel Paris, just about everyone in the investment management industry uses some form of modern portfolio theory, MPT, whether they admit it or not. Following the Great Depression and prior to MPT, very few people invested in equities. But starting in the 1950s, MPT changed that. MPT did not succeed because it was the best investment strategy. It succeeded because it was the very first systematic investment strategy to emerge from the carnage of the '29 crash and the Great Depression that followed. Investors felt it was now safer to invest in equities, primarily because diversification with MPT lowered portfolio risks. Compared to fixed income investments, investors benefited greatly from MPT by investing in portfolios of equities with significantly greater returns. But even greater gains are possible with the same or less risk using an individually tailored investment portfolio called ITIP, and here is why. Investing in fixed income has low risk but also low gains. Investing in portfolios derived with MPT and as derivatives has slightly higher risk than fixed income but much higher gains. Investing with individually tailored investment portfolios called ITIP has significantly higher gains than with MPT with the same or lower risk. Let's see why. Modern portfolio theory has two significant shortcomings long recognized in the financial industry as well as by academics. The first significant shortcoming is a flawed definition of risk as volatility, which results in a weak foundation for reducing risk with diversification. The second shortcoming is that MPT does not take into consideration what is likely to happen to specific equities based on business factors such as market size, market strength, products, services, brands, quality of management, and so on. MPT considers only the past prices of equities. Overcoming these shortcomings is the reason why it is possible to achieve higher rewards and less risk than with MPT and its derivatives. Now let's look at each of these shortcomings and how they can be overcome in a bit more detail. The first significant shortcoming of MPT and its derivatives is the faulty definition of risk as volatility. While an equity with volatile past stock prices may have a higher likelihood of decreasing in value, this is not always the case. Consider a very successful company whose stock price has been rising for many years. Although there may be a few periods where the price has decreased, most of the volatility has been on the increase, not a decrease in the value of the stock. MPT would consider such a stock as risky when the risk of the stock decreasing in value is small. Warren Buffett, one of the most successful investors of modern times, when asked about volatility as a measure of risk, said, and I quote, "The people who have written about and talk about risk do not know how to measure it. The nice thing about a measure of volatility is that it's nice and mathematical, but it's wrong in terms of measuring risk." Warren Buffett gives a simple example, and I quote, "In the early 1980s, farms that sold for $2,000 per acre declined to $600 per acre. I bought one. The volatility shot way up, indicating that I was buying a much riskier asset at $600 per acre than at $2,000 per acre. It's nonsense." It should be obvious that a portfolio based on the minimization of volatility rather than the risk of loss is short-sighted, to say the least. The second significant shortcoming of MPT and its derivatives is that the computations are based only on the past prices of equities. Relying only on past equity prices and not incorporating estimates of future events and their causes for specific equities results in portfolios that have both higher risks as well as lower rewards. Warren Buffett and his colleague Charlie Munger agree that the risks of their portfolios are small, primarily because of their knowledge about the companies in which they invest. By incorporating knowledge about the products, services, reputation, quality of management, and competitive environment of specific equities, ITIP, an individually tailored investment portfolio approach, can produce greater rewards with lower risks than with MPT and its derivatives. And now you know why it is possible to achieve better gains with the same or less risk than most investors are getting today. So, while MPT and its derivatives have been extremely beneficial to investors by reducing the risks of investing in equities rather than just low-risk fixed income alternatives, there is no need to be satisfied when it is possible to achieve better gains with the same or less risk. By defining risk as the likelihood times impact of events rather than volatility, and by incorporating information about what is likely to happen to specific equities, their causes, and their consequences, rather than relying solely on the past prices of equities, it is possible to realize better gains with the same or less risk. Now that you know why it is possible to realize better gains with the same or less risk than most investors are getting today, we will, in a future video, explain what an investor can do with ITIP to tailor a portfolio of investments to their specific objectives. Specifically, how much tolerance do I have for portfolio losses currently and at later stages in my life? What is the minimum gain I would be satisfied with currently and at later stages in my life? What is more important to me, short-term or long-term risks and rewards, both currently and at later stages in my life? Following the what, we will explain how individually tailored portfolios with ITIP can produce superior gains with the same or less risk than what most investors are currently experiencing with MPT and its derivatives. Thank you for your attention. We will soon be posting the next video explaining what you can do with ITIP to tailor a portfolio to your specific objectives.